Welcome to The Explainer. Today, we're taking a journey straight out of the everyday world you know and diving deep into the hidden engine room of global finance. We're going to decode a system so massive, so relentless, that it literally dictates the cost of the modern world. Think about it. Every imported good, every international corporate merger, and every major shift in global wealth relies on the mechanics we're about to explore. So, buckle up because we are decoding the Forex market. Now think about your last international trip. Have you ever swapped your local money for the currency of the country you were visiting? Maybe you traded your US dollars for euros in Paris. And let's be honest, you probably got an absolutely terrible exchange rate at that little airport kiosk. Well, if you've done that, you've technically already participated in this global market. But that clunky, slow, and expensive real-world transaction, it's a stark contrast to how this market actually operates. Your vacation money is just a microscopic drop in an absolute ocean of hyper-efficient digital finance. $7.5 trillion. Yeah, you heard that right. That is the daily trading volume of the Forex market. To put that awe-inspiring scale into perspective, the New York Stock Exchange handles roughly $200 billion a day, meaning Forex absolutely dwarfs all global stock markets combined. And this volume, it's not just retail traders sitting at home. It's heavily driven by massive central banks adjusting their national reserves, multinational corporations hedging against currency risks so they can make global payroll, and quantitative hedge funds moving billions in fractions of a single second. It is, without a doubt, the largest and most liquid financial market in existence. So what exactly is it? Well, Forex is short for foreign exchange. It's the global, decentralized marketplace where national currencies are traded against one another digitally to profit from fluctuating rates. And because there's no single physical exchange building that opens and closes its doors, the market operates continuously. It essentially just follows the sun, running 24 hours a day, 5 days a week. The trading week kicks off in Sydney, hands off smoothly to Tokyo, moves into London, and finally wraps up the day in New York. The absolute busiest, most volatile times happen when these major financial hubs overlap, creating this relentless, nonstop flow of capital. Section 1. Anatomy of a currency pair. To really understand Forex, you have to master its most fundamental, unbreakable rule. You never, ever trade a single currency by itself in a vacuum. Because every single transaction involves simultaneously buying one currency and selling another, they're always traded in pairs. Every currency pair elegantly deconstructs into two distinct parts. On the left side, we've got the base currency. This is the first currency listed in the pair, and its value is always treated as exactly one. Then on the right side, we have the quote currency. This is the second currency listed, and its whole job is to tell you exactly how much of it is required to purchase just one single unit of that base currency on the left. Let's anchor this with the most heavily traded pair in the world, the euro and the US dollar. So, if EUR/USD equals 1.0950, what does that actually mean for us? Well, the euro is our base currency, so its value is 1. The US dollar is our quote currency, so it costs exactly 1.0950 US dollars to buy 1 euro. These relationships are essentially the heartbeat of global macroeconomics. When a country's economy strengthens, maybe through rising interest rates or massive GDP growth, its currency usually follows suit, directly altering this precise ratio. Section 2. How traders make money. Success in this $7.5 trillion arena really boils down to one thing: predicting whether a currency will strengthen or weaken relative to its partner. Okay, let's dive into the mechanics here. There are two primary directions a trader can take. First up, going long, which is standard trader terminology for buying. You execute a buy if you believe the base currency is going to gain value against the quote currency. Then there's going short, or selling. Now, if you follow equities, you know that shorting a stock is kind of a headache. It involves borrowing shares, paying margin interest, dealing with regulatory hurdles. But in Forex, going short is incredibly seamless. Because currencies are always traded in pairs, going short on a pair simply means you are buying the quote currency and selling the base currency. You don't have to jump through complex hoops to short the market. It's just a purely continuous two-way exchange. Let's walk through a successful going long scenario to build a clear mini narrative of how profit is actually captured. Step 1. You decide to buy the Euro-USD pair at our starting price of 1.0950. Let's say a highly positive economic report comes out of the Eurozone, maybe a surprising bump in manufacturing data, and your analysis tells you the euro is going to get stronger. Step 2. Turns out you were right. The euro gains value against the dollar, and the pair's price rises to 1.100. Step 3. You sell the pair back to the market. Because it now costs more dollars to buy that exact same euro, you've successfully secured a profit on the difference. Boom, that's a winning trade. Moving right along to Section 3, the engine room. Forex operates quite differently from traditional stock trading, and there are a few unique structural elements you absolutely need to know to grasp the reality of this market. In the world of Forex, massive currency movements aren't usually tracked in full dollars or cents. Instead, they're tracked in microscopic increments called pips. Historically, a pip stood for percentage in point, originally representing a fraction of a single percent. Today, for the vast majority of currency pairs, a pip is represented way out on the fourth decimal place. Let's see how this builds on our ongoing euro to US dollar example. If the euro USD pair moves from 1.0950 to 1.0951, that practically invisible change in the fourth decimal place is exactly a 1 pip movement. Now, you might be asking yourself, why on earth does the market focus on such tiny fractions? Well, it's because the national currencies of major developed economies are inherently stable. A major currency rarely swings 10% in a single day like a volatile tech stock might, right? Central banks actively work to prevent those wild, destabilizing swings. Therefore, traders need extreme precision to capture value from this inherent macroeconomic stability. So, the absolutely crucial point here is how traders actually turn those tiny fourth decimal place movements into meaningful returns. The answer is leverage. But listen closely, because while leverage amplifies your potential profits, it equally magnifies your risk of heavy losses. Leverage is essentially borrowing capital from a broker to control a massive position using only a small initial deposit, which is known as margin. In the stock market, you might get 2-to-1 leverage. In Forex, it's not uncommon for retail brokers to offer leverage ratios of 50-to-1 or even 100-to-1. It allows a trader to multiply their exposure to a 1 pip movement, but a sudden swing in the wrong direction can literally wipe out an account in seconds. It's serious business. To sum it all up, the reality of modern Forex trading is highly specialized. It's a market counted in microscopic pips, highly amplified by leverage, and executed entirely electronically. And because humans physically cannot monitor a market that runs 24 hours a day, 5 days a week, the industry relies heavily on automation. Retail traders use pre-planned limit and stop orders to automatically manage risk while they sleep. Meanwhile, institutional players utilize high-frequency trading algorithms. They'll actually physically place their computer servers in data centers as close to the exchange servers as possible, a practice called co-location, just to shave milliseconds off their trade times, capturing pips before a human eye could ever even register a change on a screen. Which leaves us with a final, provocative thought to ponder. With advanced algorithms meticulously tracking microscopic pips 24 hours a day, 5 days a week, executing trades in mere milliseconds inside a $7.5 trillion digital arena, how will the role of the human trader evolve in the years to come? It's a fascinating landscape of high-tech finance where human macroeconomic theory meets pure machine execution. I really hope this explainer has illuminated the hidden engine room of global currency for you. Thank you so much for learning with me today. Stay curious, and I'll catch you in the next explainer.